Okay, hi everyone. Good afternoon. My name is Hannah Amir, and I'm a proud 2021 York University graduate. So I just received my bachelor's degree in health studies this past June, and I'm also one of York's Young Alumni Ambassadors, and I'm going to be your host for today. So I want to extend a warm welcome to everyone who has taken the time for our fall gratitude season. Now, the Gratitude program provides recent graduates with opportunities to learn and connect with fellow alumni. Now, an especially warm welcome to this year's graduates. We officially welcome you to our 350,000 person extended family. Now, today's session is titled Introduction to Money Management, and I'll now be giving our land acknowledgements. So, although we're not all in the same location, we recognize that many Indigenous nations have long-standing relationships with the territories upon which York University campuses are located that precede the establishment of York University. York acknowledges its presence on the traditional territory of many Indigenous nations. The area known as Takaranto has been caretaken by the Anishinaabe Nation and the Haudenosaunee Confederacy and the Huron-Wendat. It is now home to many First Nation, Inuit, and Métis communities. We acknowledge the current treaty holders, the Mississaugas of the First Credit Nation. This territory is subject to the Dish of One Spoon Wampum Belt Covenant, an agreement that peaceably shares and cares for the Great Lakes region. So if at any time you need help with this experience, or if you have questions about the content, feel free to click the Q&A button. It's at the bottom of your screen, and our team is ready and here to help you. Now, today's session is brought to you by the Alumni Engagement Team in partnership with our friends at TD Insurance. Now, TD Insurance has been a long-time affinity partner of York University, providing alumni with preferred rates on car and home insurance. And we thank them for supporting our fall learning gratitude sessions. We also recognize and thank TD Bank for preparing this session's content, along with their representatives who have joined us to present today. Now, you each came here for a reason, and we want to do our best to provide you with helpful advice as well as insight. So we would like to know, what do you hope to get out of this session today? So using the Q&A function that I mentioned before, please take a moment and type your response now. Okay, we'll wait for some of the answers to come in. Okay, and I'll just give everyone another minute or so. Okay, so someone's asking how to know what to invest in, how to invest and grow your money. Okay, I think these are really great questions. And like for me too, as like, a recent grad, I'm also really interested in this. And I think that all of these, again, investing. So investing seems to be a very big topic, and we'll definitely talk about that today. So yeah, does anyone else want to share one final last words? Oh, investing in real estate. Yep. Okay, that's a great one. Okay, so thank you guys for participating in that. Okay, so now I'm honored to introduce to you our alumni speakers. So Michele Da Silva is a branch manager with TD Canada Trust, leading a group of financial professionals, and she has worked hard in the financial industry for over 16 years. She has a degree in human resource management from York University and holds both IFIC and BCO designations. We're also joined by Stefania Giorgio, who is a branch manager at TD Canada Trust and has worked with the company for over 16 years. She holds a bachelor's degree in psychology from York and is an advocate for financial literacy and continues to take on opportunities to share her financial knowledge. So thank you guys so much for joining us today. And we'll start off with Stefania.
Thank you so much, Hannah. Very much appreciated for that introduction. Hi, everybody. I'm really excited to be here today. I take financial literacy very, very seriously, and I think it's very important, and it's one of the best things you can do for yourself is to take your money seriously and make it work for you. So I'm going to take some time today. I'm going to talk to you a little bit about budgeting and setting clear goals for yourself. And then I will pass it over to my colleague, Michelle. She'll go into more detail around credit and investing. So let's get started. So around budgeting, uh, there's 3 simple steps when it comes to budgeting. So you want to prioritize your money, look forward, so look to the future, and then adjust and realign. So let's talk a little bit about these 3 steps and what they mean, okay? So when it comes to prioritizing your money, this is where you're making your money work for you, okay? So knowing your income, knowing your expenses, setting limits on what you spend on each is how you can ensure that you're not overspending, you're not taking yourself too far, right? One of the key things that you can use that TD Canada Trust offers is the TD MySpend app. So the MySpend app really helps in showing you what your past expenses look like, as well as setting a goal for you. So it will average out what you spend on a monthly basis. It'll break it down under household expenses, discretionary spending, food, and then you can actually start and look at your numbers from there. So it really, really helps you in setting up that budget and getting it started. As well, it's a great piece for protection, right? So if you have TD MySpend, the minute your card or your account is debited, you'll actually get an alert on your phone letting you know that it's been used. So you can use it as well to prevent any fraudsters. So that's just a side tip on why the TD MySpend app is so important, okay? And tying it in with your budgeting. Okay. So now the next rule for budgeting is looking forward. Okay. So when creating your budget, you want to plan for an entire year. It's not just about next week. It's not just about next month. It's for the entire year. And then break your figures down on a monthly basis. So let's say you have a trip at the end of the year and it's going to cost you $2,400. You want to ensure that on a monthly basis, you're putting aside that $200 so that by the end of the year, you have that $2,400 put aside. So that's your additional. So when you're budgeting, it's not just about today or tomorrow, it's long term. What are my long-term goals? How can I factor it into today and make it realistic, and more importantly, make it achievable. So really important aspect when it comes to budgeting, okay? And then your last step when you're doing your budget is to adjust and realign, okay? Don't get discouraged. We all overspend at one point. We might see something that we really, really like, and we put that extra dollar towards it when we shouldn't be. But it's important that you catch yourself and you adjust and you realign and you make back up for whatever you had spent, right? So maybe this month, you spent $200 on going out. So maybe next month you only spend 100 or 50. So bringing yourself back in line and ensuring that you don't make it a regular habit will help you build the right skills and how to manage your money for yourself. Okay. So setbacks happen all the time. Again, it's important to just get back on track. So now let's talk a little bit about how we actually create a budget. Okay, so first you're going to break down your monthly income. Now, this isn't going to include everything because it's not just employment that you would get income from. Maybe you get grants, maybe you get family support, any side money, maybe you sell things on the side, whatever it might be. You want to make sure you have a realistic number of what your income looks like. The other thing is, if your income tends to fluctuate for whatever reason, what I would say to you is err on the side of caution and be more conservative with your income number. This way, whatever is over what you would have expected, that's more money that you can put towards paying yourself and putting it towards your savings. So if it's a little bit more, if you fluctuate a little bit, err on the side of caution, make it a little bit less, be conservative with your number, because at the end of the day, you're the one that's going to benefit from it. Okay. So important that you know your monthly income. The next step is your mandatory expenses. So these are actual mandatory expenses, not Uber Eats, because that's not a mandatory expense. As much as we believe it is not. Okay. So this is your rent, your groceries, your utilities, things you actually need in order to survive and do your day-to-day things. Okay. So one key aspect here is that savings is a mandatory expense. So paying yourself first is something you have to ensure you factor in when making your budget. So that number could fluctuate depending on what your income and your expenses look like. But definitely factor it into your mandatory expenses. It is not a discretionary expense. This is something that you really, really need to put a focus on and say, okay, what can I comfortably put aside for myself and be able to pay myself first, right? So that's your next step to making your budget, your mandatory expenses, and being sure that you factor in your savings plan into there, okay? Part 3 and 4, they kind of go together. It's assessing your debt and obligations and paying them off consciously and being smart about it, right? So you might have your tuitions to pay off, loans, credit cards, whatever it might be. The first thing I would tell you is if you have two separate kinds of debts and one has a higher interest rate than the other, absolutely 100% pay off the higher interest rate with the lower interest rate debt, right? So, a credit card, it could be, it's about 20%, we'll say, whereas a loan could be about 8%. So you'd want to use the loan to pay off the credit card debt. So at least you're not putting so much extra money to interest, which is going into another pocket, definitely not yours. So important that you really ensure that you assess your debt and obligations and you say to yourself, okay, how can I pay this off in the smartest way possible? How can I make my money work for me? Okay. Payday loans and cash advances are a big no-no. What happens with those is, first of all, the interest rate is significantly higher than any other credit product, okay? And they start accumulating interest from the day you borrow. So there's no grace period. When you get a credit card, there's a bit of a grace period. My colleague Michelle will talk a little further about that. But with a payday loan or a cash advance, there's no grace period and it's a higher interest rate. So we do not recommend that you take on that kind of debt, okay? Know your terms and your interest rates. Set goals and say to yourself, okay, when do I expect to pay this off? If I'm putting aside this much every month, make it a goal, put it in line with your spending, knowing that you're using that money to pay. So that money that you're using to pay off that debt, if you know, okay, by the end of this year, I'm going to have this loan paid off, well, that's going to be, let's say you were putting $200 towards that loan. That $200 could now go into your savings portion. So you're saving even more money for yourself. So once you're getting rid of that loan, you're paying yourself first. You're paying yourself back. So really important that when you free up that money, it's used for paying yourself. I would never add it to my discretionary spending. That's something that I would want to put aside and save it for me. Okay. So the last part, is figuring out your discretionary spending. So we all want to spend. We want to have fun. We want to go out, and it's totally understandable. This is where I would say be realistic. Don't overspend. If your discretionary spending is higher than your mandatory expenses, you may need to assess that and look at your situation there and ensure that discretionary spending comes after mandatory expenses and paying yourself. So whatever you're left with, that's where I would say is what you can use for your discretionary spending, okay? And then most importantly, when building any plan, especially a budget, you wanna make sure that it's a smart action plan. So you wanna ensure that it's specific. So I know I wanna save X amount of money. I know I want to, pay off this loan. Make sure it's measurable You can use the dollar amounts and figure out exactly what you want to save, what you want to pay off by doing your dollar amounts. Make sure it's assignable. So assigning goals for your money, you know that this is what this set of money is going to be used for. Make it realistic, right? So if you're making $2,000 a month, saying that you're going to put $1,800 towards paying off debt is not going to be realistic, because you're only going to be left with $200 for your mandatory expenses as well as your discretionary spending. And then what happens is you just set yourself up for failure. You get discouraged, and then guess what happens? You don't stick to the budget and it just falls off. So really, really important that you set up a smart action plan when making those budgets for yourself. So make it specific, measurable, assignable, realistic, and time bound. So I want to save X amount of money by X amount of date. I want to have this paid off by this amount by this date. And that's how you're going to set yourself up for success and making your money work for you. Please remember that your budget is a fluid document. It will constantly change. Maybe your income will change, your spending will change, whatever it might be, your expenses might change. At the end of the day, it's important to always look at it, reassess, and assign it again. Check that you're on track, see where you fell back on, see where you're over, see if you can add more to your savings. There's so many different aspects that come into a budget, but it's up to you to take control of it and ensure that you are on track for what you want to achieve. You want to make your money work for you. And the only way you can do that is by staying in line when it comes to your budget. Okay, so I hope you guys found that valuable. I'm going to pass it over to my colleague, Michele, who's then going to talk a little bit about credit and investing, and then we'll have an opportunity at the end for any questions. Okay, so please keep your questions for afterwards. Thank you, guys.
Thank you, Stefania. So I'm going to be speaking to you about credit. So I've been with the bank 16 years, and I spent almost about 7 years of that time in the credit center. So I started my journey with credit, submitting applications in branches. But then when I went to the credit center, I was actually on the other side, where I was able to approve credit applications. And I can tell you that seeing it on the other side makes you have an appreciation for all of the work that goes into a credit application and really assessing the risk. So there's going to be a few things I'm going to discuss in terms of products, but feel free to ask questions about credit as well. Okay. So I'm going to give you an overview of how a credit card works. Credit card is like a short-term loan. So if you're looking to purchase something and you know that you're going to be paying it back right away, this is a good option for you. You're maybe planning a trip, you maybe need to fix something in your car, but you just don't have the funds readily available because you're not getting paid for a week or 2 weeks. This is a great option for you. So credit cards have a credit limit. This is the maximum you can spend on your card. And a misconception I'll share with you is sometimes people think that if they're overpaying their Visa, then they've actually increased the limit, but that's not true. You've actually only inflated your available amount, which is actually a no-no as well, in terms of customers thinking that by overinflating the balance, you're making your credit look good, but it's actually the opposite. If you don't pay your balance off each month, you're going to get charged interest. So Stefania had mentioned interest can be anywhere 19, 20, 25%. On a credit card, it is the highest interest you will accrue versus a line of credit versus a mortgage. So if you're not paying your interest, you're going to be, or your full balance, you're going to be charged interest on the money you've used. And you'll find this on your statements. If you receive them in the mail, or if you check your online banking, you'll see the minimum interest that you need to pay. And there is a great benefit of using a credit card versus using cash or your debit, in that you can have some rewards. So are you going to get cash back at the end of the year for spending a certain amount? Are you going to get travel points? These are great options. but also it's establishing credit history, which is really important in the event you're looking big picture. Are you looking to purchase a home? You need to establish some kind of credit, and this is a great way to start. On the next slide, we're going to go over if a credit card is right for you. So many benefits, like I just said, of having a credit card. You should consider living within your means. So sometimes people think, oh, I'm going to get a credit card and I can do all of these fun things that I really wanted to do. But if you're not able to pay the credit card back, well, then might not feel so fun when you're getting bills in the mail that you can't afford. Do you have regular income? Going back to the credit application process, if you don't have regular income, how are you going to be able to service this debt? So it might be an issue in actually getting approved for the credit, but also in sustaining it. You don't have spending problems. So I compare this very much to gamblers. You should know your limit, play within it. So if you know that you have a problem going to the mall, maybe not a great idea to get a really high limit on a credit card. And then going back to Stefania's point about following a budget, you should think about how you're going to pay your credit card as a piece of your budget. So we mentioned your living expenses, while your debt should also be incorporated into your budget. If we move on to the next slide, we're going to kind of go over how interest works. So I had mentioned earlier, if you don't pay your full balance, then you're going to be charged interest. And this is at a percentage of whatever's left. The amount charged is called the annual interest rate, and it can be really high. Sometimes you'll get offered a credit card by going into a retail store. So Canadian Tire, for example, Home Depot, these are notorious for offering credit cards when you're shopping. And sometimes even the Bay, you'll get like, if you get the credit card now, you'll get a percentage off of your current purchase, which seems really enticing, but really important to understand what the interest rate is, or even if they give you a leeway for the first 3 months, 6 months, you're at 0% interest. What's your interest rate actually going to be when the promotion is over? So really important to find out what the rate is. And then on the next slide, we're going to talk about how interest is calculated. So don't want to put you guys to sleep, but if you're ever curious to see at how we calculate your interest, this is a really easy way to do it. So it's looking at, for example, $1,000 is your credit card balance, your interest rate on your Visa or credit card is 25%. Well, we're going to look at how many days are in the year. So going back to the annual interest rate. So 365 days in the year is divided by your rate, gives us the 0.0068, which if we multiply that by your balance on the credit card, we're looking at an interest of about 68 cents a day. And if you don't pay it for the full month, there's 30 days in the month, then you're looking at $20.50 of interest for a balance of $1,000. So obviously it's a pretty simple calculation to do, but if you're not able to do it, definitely your banker will help you. And you can feel free to check this as well on your monthly statement, like I said. Some credit cards actually will also give you a grace period, depending on which organization your credit card is with or corporation your credit card is with. A typical grace period could be anywhere from 21 to 30 days. So really important too to read the fine print on your credit card statement to see if you are given a grace period or if you get charged interest right away from the moment you start spending. When looking at building your credit history, there's something called a credit score. So you might hear or see commercials for Equifax, TransUnion. These are where your credit scores are housed. And your credit score is typically a 3-digit number that represents the likelihood you're going to pay your bills on time. The higher your score, that means the better you are at paying back your credit. So sometimes people will ask, how do I find out what my credit score is? Well, if you contact Equifax, they'll be able to give you what your score is. But I will say, be mindful of checking your score, because every time you check your score, it actually reduces your score by a little bit. And it's more so because people that are actively searching for credit typically are the ones that need it the most and are most likely not in a great position to pay back that credit. So I would say be mindful of checking it frequently. But if you're paying your bills on time before the due date, and you're not flooding your credit bureau with multiple trade lines. So a trade line could be anything. Oh, sorry guys, my camera just went off. A trade line could be anything like a credit card. It could be your mortgage. It could be a line of credit that you have. It could be a cell phone bill. It could be the 407 bill that you didn't pay. That's reflecting on your credit bureau. These are all things that will have an impact to your credit score. And on your credit bureau, there's not only the trade lines, but it also shows how many times you've gone 30 days late, 60 days late, 90 days late. And these are all having an impact on your overall score. You could also actually have a score of 0. So if you're new to the country or you've never applied for credit, your score could be 0 because you've never had anything to put on your credit bureau. Sometimes people find when they're newcomers to the country, the easiest way for them to get credit is to get a secured line of credit, or a secured credit card, where we're putting $500, $1,000 on hold in a savings account for you, and then we're able to give you a secured credit card. This is an option a lot of newcomers find that they do, but also if you're just fresh to credit, it might be an option. A 0 could also mean you've experienced a bankruptcy. That's something we don't really want to really ever get to that point. But really a 0 could just be you've never had any credit. Okay. If we go to the next slide, it gives you just some bullets. So how is it calculated? So the credit scores are based on how well or have not, the way you've not managed your payment history, your amount of debt, the length of your credit history, credit utilization. So credit utilization is, I have $1,000 credit card, it's fully maxed. That also has an impact. If all of your trades are maxed, it seems as though you're desperate and you're hungry for credit, which isn't always a great thing. New credit requests. So how many times have you been applying for credit? If you keep going to all the different banks asking for credit cards, this is going to impact your score in a negative way. Types of credit. Sometimes you're applying for, like I said, multiple credit. But what types are they? So are they unsecured products? Are they secured products where maybe it's a mortgage or a home equity line of credit? These also have an impact. How can credit impact you? So if you do have good credit, and I'll say this is more so for unsecured products. So if you have a great credit score, you're more likely going to be getting a better rate on a line of credit, an unsecured line of credit, because you've built that relationship, you've established that rapport with your bank that you're trustworthy, you're going to be able to pay back this debt. You'll also find that sometimes people that don't have the greatest credit won't get qualified with one of the big 5 banks, and they'll have to go to a B lender. Those B lenders much more open to charging higher interest rates. So another reason to have great credit is keep your interest costs low. Credit card fees, so late fees. If you missed your minimum payment, so if you go back to that earlier slide where your interest was $20.50 and that was your minimum payment and you missed it, there could be a fee there. Annual fees. So some credit cards have, like I mentioned, cashback features. They have travel points. Sometimes with those higher reward cards, you're looking at higher annual fees. So could be $100, $120, $150 to have a credit card. But when you offset the benefits that you're getting from that credit card, you might actually still be in a positive even with an annual fee. So really important when picking a credit card to make sure that you're picking one that gives you the most benefit. Cash advance fee. So if you do a transfer online from your credit card to your checking account, for example, you're accruing interest right away, most likely. Are you taking cash out of your credit card at an ATM? That's another way you can be doing a cash advance, and there might be a fee on that in addition to your interest. Foreign exchange fee. Maybe I like shopping on websites that are only in the US. I'm going to be charged US dollars, which could incur a foreign exchange fee as well. Sometimes too, going back to overpaying your credit card, you could have an over limit fee. So at the end of it, are credit cards a good idea? Yes, they definitely have some real benefits. If you can handle them responsibly, use them properly, pay them back on time, they definitely are a great idea. They're going to help establish your credit history. You're going to be able to get some rewards. So I have a travel credit card, and I look forward to using it once things kind of go back to a little bit more normal, and using the points that I've accumulated over the last little while. In terms of flexibility, there's always an option to set up pre-authorized payments. So if you're not that responsible or you forget to pay your bills, definitely there's options where the payments can come out of your checking accounts. Credit cards are also a great idea in terms of they're the only option sometimes. Sometimes you can't make purchases online. Maybe you want to book a hotel, a car rental. The only option is to use a credit card, and it's a necessity. Another question we get asked often is, should I pay down my debt or save money? So you need to ask yourself, are you okay with debt? Are you going to be able to sleep at night knowing that you have this debt? Is it going to stress you out? What interest rate are you paying on your debt? So you need to look at, am I getting the best rate? Can I maybe shop around? And this is very typical of customers that are looking to get mortgages. Is this bank going to give me the best rate on the biggest purchase of my life, or should I go to the bank next door? Is my debt tax deductible? Maybe I'm self-employed. Maybe I'm able to write off this debt. What rate of return am I getting on my savings? So full transparency with you, the interest rates on savings accounts aren't what they used to be. We're looking at sometimes 0.001, 0.005 on an everyday savings account. Is it really worth it to be paying 21% interest on a credit card when I'm not getting any money on my savings account? So really assessing the breakdown of interest rates from savings and from credit. And then do taxes reduce my rate of return? And then moving on, we're going to go into investing basics. So a lot of you have probably heard about RSPs. So what is an RSP? So it's a registered retirement savings plan. So this is really looking to set up Canadians to make sure that they have some type of income when they retire. So there's a tax deduction when you contribute. And we get this question all the time as bankers, how much should I be putting into my RSPs? Well, I'll let you know that on the bottom of your notice of assessments, it actually tells you what your contribution room is. So if you've never made the contribution, most likely you have a lot of room. And if you look down at the 5th bullet, it says contribution room is 18% of your previous year's income and unused room is carried forward. So maybe this year you didn't make a contribution and you're not able to, but next year you can make up for that space. There's a few great programs that the government has really incentivized I want to say Canadians to use. So the home buyers plan. So if you're looking to buy your first home, you can put up to $35,000 in an RSP that you can then take out tax-free to purchase your home. There's also the lifelong learning program where if you're looking at going back to school, then you can use that as well from your RSPs and it's not going to be impacting your tax. Contribution room is also lost when withdrawals are made. When you're looking at the TFSA option, so very different option from RSPs because it's actually, there's no taxes on earnings or withdrawals. So this was a great thing that the government brought in 2009, where each year the annual limit could change. So depending on what year it is, there's a max limit you can make. But if you haven't, so similar to your RSPs, if you haven't made the contribution for this year, then you can carry forward your limit. So you can have both short-term and long-term savings in a TFSA. There's no tax deduction on your contributions, unlike an RSP where there is. Contribution limits are set each calendar year by the government. So in 2020, it was 6,000, but also for 2021, it was 6,000. Contribution room is restored when the following calendar year withdrawals are made. So if you had opened a tax-free savings account in 2009 and never made any contributions, in 2021, you could actually put in $75,500 and it would all be tax-free. So a really great program here to incentivize Canadians to start saving some money by not having it taxed. And that comes to the end of the TFSA portion and my portion overall. I think we're going to go to the questions now, Hannah.
Yeah, perfect. So thank you guys so much. I'm sure everyone enjoyed hearing that. For me, like I just graduated and I got my first job, and like I got my paycheck, and all of these like questions kind of came to my head, and you guys managed to answer a lot of them. So I'm sure like a lot of us like new grads like who just graduated in like June, we were thinking like the same things. And I think it's really important too for like a lot of the younger alumni that like we talk about this now, because it's really going to be like setting us up for like success later on, and like building really good habits. Because like I mean, for me, like I'm not really thinking too far of like, oh, do I want to buy a house because I'm only 22? But then I'm like, well, at some point I probably do, and it should be a good idea to like get savings, or not like spending all my money on like coffee or shoes. So yeah, it's really great. And I do have some questions for you guys. So the first question is, can you recommend some books or websites to learn about the basics of investing? And Stefania, if you want to answer that.
Yeah, so TD's got a great website. It's tied in with our direct investing, and it's the TD Goal Assist. And it's for intro investors. They offer webinars, snippets of different types of investments and what they mean, and what you can get out of them. So they put the link in the chat, and I think that's a really, really good link to go through to get some understanding of your intro to investing and your basics, and growing from there. And then you can continue on, and it kind of becomes the rabbit hole, right? So you'll click on other things, and as you proceed, as you go forward and you learn more and more, you'll find that there's different products for different types of investments that you're looking for. So that's a really, really good one that I would recommend.
Okay, perfect. Thank you so much. And then we have a question from the audience. So I'll just give this one to Michele. So does your credit history begin as soon as you are approved for a credit card, or when you apply for a credit card?
Yeah, so as soon as you apply for a credit card, there's a credit bureau impact. So sometimes people will say, oh, is it a soft hit or is it a hard hit? It's a hit at the end of the day. So as soon as you apply for the credit, it is impacting your bureau, but not necessarily for the very first time going to have a score. It's just going to be kind of an impact to starting something. So opening up that credit bureau.
Okay, great. And then we have another question from the audience from Daniel. So it says, hi there, thank you for joining us today. My question is, if I have savings, but also have student debts from government loans and a line of credit, should I pay back those debts as soon as I can with savings during their grace period after I graduate? Or should I invest the savings and pay back the loans over time, even though it occurs interest? Thanks. So if both of you guys, either one of you guys want to do this one.
So one of the things I would say to that, it goes back to, first of all, you want to pay off the highest interest with the lowest interest. That's the first thing. And then from there, it all depends on what you're earning, right? So if you're in an investment that's earning you 8%, we'll say, and you're paying a 2% interest rate, you're still getting the advantage of 6%, right? So that's something that you have to take into full consideration. It's a full picture kind of answer, but definitely start with paying off your highest interest and then look at what you're earning and you can base it from there. But those are the key numbers that you want to look at, and that will tell you what would be your best option. Michelle, anything you wanted to add to that?
The only thing I would say is sometimes you're given a grace period when you're still in school. So if you're not being forced to make payments, or you're only able to, or you're only required to make interest payments, maybe look at just making those payments. And once you've graduated and you're in your career making a little bit more money, hopefully, you'll be able to kind of then assess interest rates. But if you don't have to make the payments right away, then the interest payments are a great option to stick with.
Okay, great. And I just want to remind everyone to submit questions through the Q&A function. So as they come in, I'll be asking them. So please submit your questions. So the next question that I have here says, as a young person, when should I start saving for retirement, especially if I have school debt?
Right away. Right away, whatever you can put aside, just like I said earlier around budgeting, pay yourself first. It might not be, such a large amount as opposed to when you're in your career and you're making more money, as Michelle said, but every little bit helps. You can start off by doing as small as $50 a month. But it starts, it's a start, it's something. So there's definitely no time period, it's right away.
Okay, and then for if you're doing like retirement savings, would you say to put that in the, I think it was RRSP or the TFSA? Because like for me, like I took a finance class and they were saying like as a young person, like put most of your money in your TFSA and like then put it in your RRSP when you're older. But I'm just wondering like what would be the best way?
Yeah, so I think it,
go, Michelle.
sorry,
Yeah,
Stephanie, I think it's really important to have a good conversation with, if you have someone doing your taxes for you, if you're noticing that you're paying a lot of money back at the end of the year, maybe this is when you're going to want to start opening an RSP, because then you can at least reduce the amount of income you're earning, and then you aren't going to be in such a high bracket to pay taxes. If you're living at home, you don't really have that many expenses, you know what, you're getting money back from the government every time you do your taxes. Maybe an option for you would be a TFSA because you're not feeling the impact as of yet.
Okay.
But once you do start making income and you're starting to notice that every year you're paying taxes at the end of doing your taxes, then maybe it's a good option to get an RSP, but you can always have both at the same time.
Okay.
So just because you have an RSP doesn't mean you can't also regularly contribute to a TFSA.
Got it. Okay, perfect. We do have another question. How do I know if my savings account is tax-free?
Yeah, so ask your bank. They'll tell you right away if it's tax-free. And when you're opening your account, most likely we would have asked you what your option was, because that would be a determining factor in what type of account we would have opened for you.
Okay, all right. And then another one, is there a general percentage that I should follow when it comes to spending on non-essentials each month?
So I wouldn't say that there's a general percentage, but as I mentioned in the budgeting, if your discretionary spending is far surpassing your expenses or far surpassing your savings portion that you're paying yourself first, I think that's where you really need to reassess and say, is it really mandatory that I'm spending this much additional? Because at the end of the day, we want to have fun now, we want to live now, absolutely, but you have to plan for the future, right? Those years where you're going to want to buy a home and all these major things they're going to come quickly, and it's better to be prepared than to be caught off guard when it comes to that. So I would definitely look at your numbers, and that's why the budgeting is so important. So you can say to yourself, whoa, I am actually spending this much on just discretionary spending. How can I scale it back?
Okay, got it. And then someone else is asking, so as a young grad, do we need to start having savings in an emergency fund?
Yeah, so there's no hard and fast rule of how much you should be saving. Really depends on the individual and how much they're able to afford. If you go online, you'll see that some people recommend 3 to 6 months of earnings to be put aside in the event of an emergency. Sometimes people even like to have a line of credit as a source of emergency funds in the event that they need to have cash accessible. Really depends on the individual situation, and if you're not working, then you can't save money. So really looking at what your expenses are, going back to your budget, paying yourself first, those are key indicators of how much you should be saving as an individual.
Okay, great. And someone's asking, what are your thoughts on investing in stocks? So maybe we can talk about like ETFs or holding stocks like individually. Which
Mhm.
one would be better?
Yeah, so there's definitely a whole bunch of options. And going back to the RSP and the tax-free savings, it shouldn't be one versus the other. It should really be looking at how do these both incorporate into my financial plan. And within both of those, you have the option to do stocks, you have the options to do mutual funds, GICs, or even just regular savings. Um, but really, if you're a new to investor or you're new to investing overall, I wouldn't say getting a tip from a friend about a stock that they heard about is a great idea. I would say maybe ease your way in, speak to a financial advisor and get some advice. Whenever purchasing a mutual fund for a customer, we always ask a series of questions to really understand your knowledge of investing as well as your time frame. If you're looking at using the funds in the shorter term, maybe buying a very aggressive, risky stock isn't a great idea because the fluctuation in a day could be so much that if you need that money in the short term, it won't be there because it's taken a hit. Really looking at time horizon, investment knowledge. These are all things that we're looking and taking into consideration when giving advice about investments. And if you're asking if you should invest in stocks, yes or no, probably not a great idea for you because you just don't know enough yet about it and you would need to educate yourself.
Okay. And someone was asking about any budgeting tools. So yeah, I think Stefania mentioned some, but maybe if you guys like have any more, like I see a lot of the times, even like on social media, sometimes there's like a lot of advertisements, like companies are like, use this budgeting tool. But then a lot of the times there's probably like, fees that you have to pay for that as well. So maybe if there's like free ones, like I know even on like sometimes like on Google Sheets, like they have like something there that we can use. But maybe if you guys have anything else like free resources for students that you haven't mentioned.
So I'm biased, and I'm going to go back to the TD My Spend app. I really think it's super fantastic. I use it for myself. My customers regularly use it. It really gives you a clear-cut picture, and it's very detailed and outlined, and you can sort by different categories, and you can make that budget for yourself. So that would be the key one I would say to go to. Yeah, Google has budget, the spreadsheets, I've seen them. You can definitely use that as well. I think it's whatever you're most comfortable with, whatever you can bring up easiest, but most importantly, whatever you're going to stick to. So whatever works for you, like even if it's just you make your own spreadsheet, just make it easy, accessible, and review it and make sure that it's realistic. So that's what I would say.
Okay, thank you. So yeah, I just want to remind everyone, keep submitting your questions. There's one here that says, I'm looking to purchase a house one day. Any tangible tips on improving your credit score? And I just want to kind of add to that questions. Like, when you're buying a home, like what are they looking for? Because I know, like, I'm sure part of it is credit score, but like what else are they taking into consideration?
Yeah, so I'll take that. So there's a few things when looking to purchase a home, really looking at what's your income like? What is the amount of debt you're going to be able to support? What's your credit history like? So do you have any credit established? Do you have a credit card? Do you have a line of credit? Do you have a loan? Are those payments all being made on time? Do you have any savings? So when applying for a mortgage, we're doing an assessment of everything in terms of your assets and your liabilities. And we're looking to see how much are you going to be able to put down on this property. And if you're putting less than 20%, then we're actually going to have to go and get you an insured mortgage. So have you started saving for this property that you don't even know about yet? Really key to start saving before you even think about purchasing. So something else that we can help you with is a pre-approval. And you can find these online, all of the banks. Even if you just type in a search on Google, you'll find a pre-approval calculator. And you're really just looking at how much your income is versus your debt. And there's two ratios that we consider. So your gross debt servicing and your total debt servicing. So making sure that you're within these ratios means you're going to be able to make sufficient income so that we aren't using all of your income for your housing costs. So there's a sweet spot. It's typically around 35 and 42% for the GDS TDS ratio. And when you're doing these pre-approval calculations online, it's really taking that into effect. So if I have a really expensive car and my car lease is, I don't know, $1,000 every 2 weeks, well, that's going to take away from the amount I'm going to be able to qualify for because I'm paying so much from my income towards that car lease or car loan. So really looking at, I might have a great salary and great income, but B, do I have a lot of debt that I have to pay every month? And that's going to have an impact on how much I'll qualify for.
Yeah. Okay, perfect. So we have two more questions. So this one's a follow-up about investing in stocks. So what's the best way to educate yourself on stocks?
Yeah, I would say going into your local branch, like any branch will be able to say, not specifically to a stock, but we can give you different options. Sometimes people just like to go online themselves and just read about investing. There's a whole bunch of books out there about different strategies for investing. I'm sure if you ask people, they'll tell you, oh, I just bought this stock and it's doing great. People love to brag when their stocks are doing well. But really feel free to go into any branch of any bank, and I'm sure they'll be able to help you in differentiating what type of investment you should be in based on time horizon.
Yeah. Okay. I think that's great because
Sorry, I
yeah.
want to add to something. That link that I sent, the Goal Assist link, there's actually a link that says, what stocks should I be investing in? And you
Oh,
can actually click into it and answer some questions, and it'll direct you to all different types depending on what your knowledge is. So it's a really, really good link to get yourself familiar with online investing if that's something you're interested in.
okay. Sounds good. And we do have our last question over here. So why shouldn't I keep the majority of my money in a savings account as opposed to an RRSP or a TFSA?
So first one is definitely interest. So savings accounts will give you a very, very minimal interest. And then there's the tax benefit, right? So if you're investing in a TFSA and you put it into an investment, whether it be a stock or a mutual fund, whatever you're earning tax-free. So you don't have to pay any taxes on it. You don't have to declare it. The same thing with the RSP. It's actually being deducted, as Michelle said, from your annual salary. So you're getting a benefit from paying taxes on it. So those two are your key factors. The TFSA has the most accessibility if you need the funds, whereas the RSP, you are limited. There could be some tax implications if you're taking out from it. But definitely, if you're putting money aside, if you have a savings account, look at the tax-free savings account. It probably will add the more benefits to you in the long term.
Okay, perfect. All right, so that wraps things up for today. So Michelle, Stefania, thank you guys so much for taking the time to join us, to share your knowledge and insight with the York University students, alumni community. So would you like to share some final words of wisdom with our alumni?
Yeah, I think if I had one final thought, it would be, you know what, feel free going into a financial institution right now. There's a lot of COVID precautions that have been put in place. We have plexiglass, we have sanitizer everywhere. We're safe for you to come and visit, book an appointment. But I think really there's always somebody to help. And no matter at what point you're in your investing or credit journey, will be able to support you. So never feel like there isn't someone to give you an answer or a solution or an option, because there's a lot of options that you might not know about, and we'd love to help you.
Okay, great. And Stefania, if you want to mention anything.
Yeah, I think Michelle said it perfectly. You know, I just want you guys to remember it's never too early or it's never too late to start thinking about your finances and getting things in order. So get in, talk to somebody. We love meeting with our customers and providing guidance. I mean, that's why we got into it in the first place, is to help our customers. So definitely not a burden. We want to see you. Come talk to us, and we're here to help.
Okay, perfect. So, and thank you guys to our students, alumni, friends for joining us. And we have a question for all of you. So please answer in the Q&A box, which aspects of today's event did you find most meaningful or helpful? So the Q&A button that you guys have been using, if you want to just type the answer in there, that would be great. And this really helps inform our events team moving forward, and also how we can tailor these events to better suit all of your needs. And feel free to share today's talk with your friends. So it's going to be posted on our York Alumni YouTube channel. You may also join our LinkedIn group or follow us on Facebook by searching York University Alumni. And then you guys can follow us on Instagram and Twitter, and the handle is at York U Alumni. And then feedback about this event is welcome. And you can send it to us either on our social channel, so just message us like a direct message, or you can email us. So the email address is alumni@yorku.ca. And I can type it in the chat as well. And if you want to learn more about the alumni community, make sure to visit yorku.ca/alumni and friends. We are building events and services to support our young alumni, and we would love to hear your suggestions of perks and different programs to complement what we offer. And again, thank you all for attending the event. Our next gratitude session is on September 28th, and it's titled About Grad School, It's Never Too Late. So you can hear from a panel of recent grads on their grad student experience, and you can also gain tips on applying to grad school. So the event registration is now open. So please visit us at alumniandfriends.yorku.ca if you'd like to attend. And we look forward to seeing you guys there. So wishing you all continued health and wellness during this time. Thank you so much.